efficient market hypothesis. And basically what it says is that there are thousands or millions of investors, and they are, most of them, or some of them, intelligent, literate, numerate, objective, rational, computerized, and highly motivated to make money. And as their joint efforts cause stocks, I'll just say stocks, but all investments, stocks to be fairly valued. You see? And if there's a stock out there and it's undervalued and people read about it, they figure it out, they bid for it in the market, they go out to buy it because it's a bargain, and their buying causes the price to go up. If there's a stock out there and it's too high, they study it, they realize that it's too high, and they sell it or sell it short. And their action causes the price to go down. So the bargains get raised in price, the overpriced securities get underpriced, and eventually the prices converge with something called fair value. So there's this thing called fair value. This is dollars. I'm not going to tell you what this is right now, but securities are priced like this. So some are below fair value and some are above fair value. But when people, all these people that I mentioned, study the market, they buy the cheap ones and they cause the prices to converge with fair value, and they sell the expensive one and cause their prices to converge with fair value. So by the end of this process, it just looks like that. And all the prices, all the stocks are on this line, the so-called efficient frontier. Now, what's on this curve here, this axis, is risk. So there's an assumption, which I'll talk to in the second chapter. There's an assumption that people are risk averse, and because they're risk averse, they have to be, if they're going to make risky investments, they have to be tempted with incremental return. If I offered you, I have a treasury bill that'll guarantee a 7% return if you hold it for a year, or I can put you into a portfolio of venture capital startups in Silicon Valley and AI, and if we get lucky, I can make you 7%. Well, you'll take the T-bill because it's a sure 7 rather than an uncertain 7. Everybody likes certainty rather than uncertainty. QED, you have to be incentivized to take risk. So anyway, so the efficient market hypothesis posits that because of the concerted action of investors, prices converge with fair value, everything is priced right, and you can't beat the market. That's the bottom line of what's called the strong form of the efficient market hypothesis. This is the stuff that Sherry mentioned that I went to University of Chicago, and I was very fortunate to get a graduate degree there in business. I went there in '67, and something called the Chicago School of Investing Theory had just been invented in '62, '64. So I was very fortunate to be among the first classes of students who were taught this stuff. And if you've read Malcolm Gladwell's book Outliers about demographic luck, which is right time, right place, this is an example. It's great to be born at the front of the line, and in this regard, I was. Anyway, so the efficient market hypothesis says you can't beat the market. And what I would say is it's not that you can't beat the market, but it's hard. And rather few people can do it. And when I went to Chicago, the professor said, and by the way, if you look at equity mutual funds, equities is another word for stocks. Mark Twain defined the profession as a conspiracy against the laity. And they use all these big words. But so in the profession we say equities, but you people say stocks. So if you look at equity mutual funds, most equity mutual funds don't even do as well as the S&P 500 before fees. And then they charge you a high fee for their efforts, and they do notably worse after fees. So what they said when I was there is, why don't they just buy one share of every stock in the S&P 500? And that was something that didn't exist at the time, but it now exists, and it came into existence really in '74 when Vanguard organized the first index fund, which all it does is replicates the S&P 500. And it guarantees you S&P performance. And because there's no brain power required, no effort, there's almost no management fee. And it's dirt cheap and guaranteed to give you average performance. Now, average performance isn't so great, but it's great if on average most people do worse than average, which they did. Why did they do worse? Because they spent their time buy this, sell that, buy this, buy twice as much of that, and less of this, and buy that, and they paid commissions to engage in all those transactions, which didn't add any value because on average they weren't right. So this is the efficient market hypothesis. And when we were talking before, Sherry said to me, well, do you believe it? And my answer is that it is not correct, but it's relevant. And if you swallow it, you'll never make an investment because you'll assume that your efforts will be for naught, and all you'll do is invest in index funds. But on the other hand, if you ignore it, you're going to get into trouble because it is relevant and there's a lot of truth in it. There are a lot of other investors out there. They're all trying hard. And my distillation of the importance of the efficient market hypothesis is very simple. The other people aren't idiots. That's what the hypothesis says, and it's true. I mean, it's like you're playing golf, and you think you're going to beat everybody just by going out there, but they happen to be pretty good, and they will be probably as good as you or better. So it's one of the biggest mistakes you can make in life, but especially in investing, is to assume that you're smart and everybody else is dumb. So, for example, you wake up in the morning, you turn on the TV, you say General Motors is at 64. You say, I think it's worth 74. It's a great bargain. I'm going to buy General Motors. It's going to make $10. Easy. Why is it at 64? It's at 64 because thousands of investors have cast their vote that day and said, GM's worth 64. That's why it's selling at 64, because some people want to buy it there, some people want to sell it there, but on average, they're willing to transact at 64. If you say, no, it's worth 74, then you're saying they're all morons. Because on every transaction, every time GM trades at 64, somebody sold it at 64. Are they all stupid? Or are you stupid? And Charlie Munger, who was Warren Buffett's partner, once said to me back in 2011, I think it was, he says, just remember, none of this is easy, and anybody who thinks it's easy is stupid. Charlie was very brusque and direct, but it's true. I mean, everybody's trying to make money. Everybody's best efforts combined have caused General Motors to sell at 64. And you're going to walk in and you're going to say, no, 74, and you're going to be right, and they're all going to be wrong? What's the chance? And that's what people do. They walk in and they say, oh, that one's too cheap, I'll buy it. That one's too expensive, I sell that. That one's too cheap, that one's too cheap, I'm going to buy that one. I'm going to exclude that one from my portfolio. This one, I'm going to double weight versus its weight in the S&P. This one, I'm going to half weight. and what is the probability that you're getting those decisions right better than others? So, one of the things I believe very strongly, I mean, you obviously shouldn't be in the investment business if you think you're never right, but you are going to get into trouble if you think you're always right. And um, so a strong sense of humility has to inform everything you do in the investment world.